Hey, what's good? It's your boy Matthew Michael, and if you're here because you want to learn how to trade options, keep watching because that's exactly what we're going over in this video. Now in this video, I'm going to go over basic options terminology with you, as well as actually go over a live example of how to buy and how to sell an option. Now I've worked hard on this video, and the only thing that I really ask in return is that you smash the like button so this video gets pushed to the audience who needs to see it. And also, if you're interested in signing up for Webull and getting up to 4 free stocks, be sure to check out the referral link down below in the description. When you sign up for Webull using the link down below in the description, not only do you get up to 4 free stocks, but it also really helps to support the channel. So for those of you who sign up for Webull using the referral link down below in the description, thank you. But without further ado, let's get into it. So first things first, what is an option? An option is a contract that gives the buyer the right to exercise 100 shares of the underlying stock at the strike price before or on expiration. Now to me, that seems simple enough, but if you're new to options, there are likely some terms that you did not understand in that definition. And I take it as my personal goal for you to understand just exactly what the heck I'm saying. So let's take another look at that definition and try to make sense of what everything is. Now, I'm sure that everyone knows that a contract is a legal agreement. An options contract is just a legal agreement that represents 100 shares of a stock. Now, in that definition, when it says exercise, this has nothing to do with going to the gym. In this case, exercising just means using the rights that come with the contract. So for instance, if I wanted to buy 100 shares of a stock at a certain price because the stock price went a lot higher, and I also just so happen to have a call option, I could exercise that call contract, buy 100 shares for the strike price, and pay a lot less than what it's going for on the market. And by doing that, I would have a better average cost on that position. Now I just said strike price again, which is used in the definition for option, but basically all the strike price is just the price that you want to exercise the contract for. So for instance, if you had a strike price of $10 and you decided to exercise that call and get 100 shares for $10, you would pay $1,000 for 100 shares, or that would work out to be $10 each share, which can really come in handy when the stock moves up dramatically. And the last word in that options definition that you're going to want to know is expiration. Each and every options contract has an expiration date, so all an expiration date is going to be is just going to be the last date that you have to exercise the contract before it goes away and is completely worthless. When picking out an options contract, one of the first things that you'll actually do is pick out an expiration date and then choose a strike price for the contract. This will also determine the overall value of your contract, but we'll get more into that later. Now that you know what an options contract is, we're going to talk a little bit about the different reasons that people choose to trade options. We've already covered the fact that an options contract covers 100 shares of the company's stock, and because of that, there is a lot of money that can be made trading these contracts. On a contract's expiration date, every penny that a contract is in the money represents $1 of that contract's value. That means that just a move of $1 will cause a contract to be worth $100 on expiration. Because contract prices can be so volatile, one reason that people trade options is to make large profits really fast. Another reason that people trade options is for the protection of their assets. For example, if someone buys a put, they do so in hopes that the stock price goes down. Because with the put contract, the put gives them the right to sell 100 shares of the stock at the strike price, no matter how low the price of the stock goes. So for instance, if a put were purchased at a strike price of $50 and the stock fell down to $35 per share, the owner of the put contract has the right to sell 100 shares of the stock at $50 when it's trading at $35 on the market, resulting in a net profit of $15 per share, which turns out to be $1,500 for the whole contract profit. In this situation, not only did the contract holder protect themselves from a loss, but they also took a pretty decent profit as well. One might also decide to trade options in hopes of acquiring shares at a lower price than what it's actually trading for on the market. For example, if someone buys a call with a strike price of $20, and if for some reason that stock runs up to $43, the person who bought the contract has the right to exercise that contract and buy 100 shares for $20 while it's trading at $43. That right there is well over a 100% profit. Now there are definitely a lot more reasons that people trade options, but those are going to be the main three if you ask me. Whether it's for profit protection or just having a lower cost basis, There's a strategy for it. Now, I wouldn't be keeping it real if I didn't tell you there are a lot of risk associated with trading options. The main one being that just as fast as you can make money with trading options, you can also lose money trading options. Now, here's something I really like to stress. When you buy options contracts, the most that you can lose when you buy an option contract is the price that you paid for a contract. So remember that whenever you're buying an option contract, if you're putting in a lot of money, before you actually purchase that contract, ask yourself, are you okay risking all this money? What would you do if you were to lose all that money? You definitely don't want to throw everything you've got into one trade, because that trade could very well be the end of you having money. So basically what I'm trying to say is, don't risk any money that you can't afford to lose. And some of you may be wondering, how is it possible to lose everything you put in? Basically, this happens when no one wants to contract anymore and the option expires worthless. The bright side of this is the most that you can lose is the price that you pay for the contract. But of course, this only applies to buying to open contracts, not selling to open contracts. And we'll actually cover the differences between the two later on in this video. But for now, just know that when you buy to open a contract, the most that you can lose is the price that you pay for the contract. While with selling to open contracts can be much more catastrophic to your portfolio should things not go your way. Which is why personally, when you're first starting out trading options, I personally think it's better to buy to open options contract than to sell to open options contract, at least until you kind of understand how to sell to open contracts. Now that we've covered the main risk associated with trading options, let's dive into one of the two main types of contracts and what it is. Now, we already spoke on this a bit earlier, but a call is going to be a contract that is going to increase in value as the price of the stock goes up. And a call gives the buyer the right to buy 100 shares of the stock at the strike price on or before expiration. While a call contract gives the buyer the right to buy 100 shares at the strike price, there is no obligation for the buyer to buy 100 shares of the contract if they do not want to. Over the long term, call options can prove to be more favorable than put options, since on average the S&P 500 goes up about 10% each year. But this doesn't always mean that calls will be the best answer, so we're going to go over puts as well. A put option gives the owner the right to sell 100 shares at the strike price on or before expiration date. The value of a put option actually increases as the value of a stock goes down. And just like with the call, just because a put gives you the right to sell 100 shares of an option does not mean that you have the obligation to sell. Just looking back at history, the stock market usually drops a lot faster than it goes up, so timing is definitely of the essence when it comes to buying puts. And to answer a question that I often get about buying puts, it's actually not a requirement that you own 100 shares of the stock just because you're buying a put. Now, before purchasing a call or a put, it may be a good idea to check out the max profit and the max loss to see if it's even worth it to buy the contract. A majority of trading platforms will display this information somewhere before you actually buy the contract. And for those of you who don't understand max profit and max loss, it's not anything complicated. They're basically exactly what they sound like. When you buy a contract, the most that you can lose is going to be called your max loss, and is typically going to be equivalent to the price that you paid for the contract. The max loss usually occurs when the contract is way out of the money and seems to have no hope of expiring in the money. So one thing that you'll notice for all of the out of the money options is if they're not moving any closer to the money as the contract expiration nears, the value of the contract just gets closer and closer to zero until ultimately it ends up expiring worthless. Now, on the other hand, with the max profit, those work just a little bit differently. Just because with the max profit, your limit kind of depends on whether you have a call or a put. Because if it's for a call, the max profit is theoretically limitless because the stock price can go up with no end in sight. But when it comes to puts, the max profit is going to be equal to the strike price times 100 minus the price that you paid for the contract. And that's going to give you your max profit, because unlike the fact that there is no limit to how high the stock can go up, there is a limit to how low the stock can go. The stock cannot go negative, it can only go to zero. So when you buy a put, the best thing you can hope for is the stock to go to zero. So when you buy a put, you have a max loss and you have a max profit. But when you buy a call, you only have a max loss and your max profit is limitless. Now, right along with your max profit and your max loss is going to be your break even. And that's just going to be the minimum amount that you need the stock to move in order to not have made money, but not have lost money. Now the break even will usually be a number that's in the money. So it is possible for a contract to expire in the money and still not be profitable because it hasn't reached its break even yet. The break even for a call will normally be above the strike price, and the break even for a put will normally be below the strike price. Now I think I've done a pretty decent job of explaining the break even. Now let's take a look at an example.
All right, so here we are in the good old Webull. And what we're going to do is take a look at the break even. And I actually have a couple contracts on Alibaba right now. So what better contracts to take a look at than some real live ones I'm in right now? All right, so yeah, let's go to Alibaba, hit positions. And here you see I am in 2 Alibaba 265 calls. As you can see, they're currently out of the money because Alibaba is a little under $30 away from the strike price. Yet I'm still profitable on these even though they're out of the money. So now let's click on the actual contract and let's hit quotes. And as you can see, kind of in the middle of the screen, just under the volume, it says break even. And really where the break even is most important is on expiration. This is the price I need Alibaba to be at on expiration for me to not have made money or lost money on these contracts. So that right there is the break even in a nutshell.
Now I just showed you how to look at the break even. Now let's get in Webull again and take a look at how to open a contract. All right, so here we are in the Webull mobile app. And what we're gonna do right now is, we just talked about it. So we are going to open a call, and we're also gonna take a look at all the things that we've talked about in this video up to this point. All those things that you need to pay attention to on the home screen whenever you're purchasing. So we're going to start out by going to Apple. This is what we're going to be buying the call on. In order to be able to trade options on Webull, you have to first go into your settings and apply for it. But after you're accepted, if you want to trade options, all you have to do, go to the stock like how we're on Apple right now. And Apple is actually falling quite hard right now. So may not be the best time to buy a call, but I'm just going to do it because this is what I planned on doing, and we're not really going to put too much into it right now. So my next step is going to be right here. We're on the Apple screen. Down here at the bottom where it says options, I'm going to click on that. And right here you see the option chain. So right here, if you notice here, kind of at the top left under the strike price, we have 18 December 20. So what that means is the expiration date is December 18th, 2020. And actually, if you tap that line where that's at, it'll close it, and you can see all the expiration dates that you can choose from. Notice the further out you go, the more expensive they get. So look for something that's at the money. So right here where it says stock price 125.94, that's considered at the money. For the 18th, a little bit above the money is 125, and 125 is 206 for the 18th. If we go out a week to the 24th, 125 is 310. If we go out another week, 125 is 385. So when it comes to buying an options contract, time is literally money. So the more time that you have on your contract, the better your chances of success. But also just be aware, as time wears off, some of that value will come off. All right, so going back to the 18th, I'm not really trying to get that much time on it just because I'm just trying to show y'all how to buy and how to sell. So now that you kind of know what the different expiration dates look like, let's pay attention to some of the things we see on the screen. So right here where you see the bid right next to the strike, that is the highest price that anyone has offered for the options contract that's out right now. So usually if you want your order to be filled faster, you're going to want to put in a price that's above that bid. And just to the right of the bid is the ask. And if you want to get filled instantly, put in an order directly at the ask and it'll be filled immediately. And somewhere in between the bid and ask is the mid. It actually shows that all the way on the right. That's usually a good place to start. You have a good likelihood of getting filled, but sometimes the bid and the ask are so far apart that the midpoint is just too far away from the ask. You may not get filled. So if the order doesn't get filled right away and you're trying to get in fast, try to pay closer to that ask price. And then when you see last, last is just the last price that it sold for, and percent change is the percent that the contract is up on the day. All right, so if I just click on here, I'll probably, 129. Yeah, we'll click on the 129 strike. So I've chosen the contract I want. And if I hit edit, one of the cool things about Webull is all the information it gives you before you buy. You can kind of see some of the things we discussed in this video. Kind of in the top left, you see the strike is for Apple. It's a 129 strike, so anything above that is in the money. Apple goes above 129. This call is in the money. Right here where it says max profit, the max profit is unlimited because, again, when you buy a call, your max profit is unlimited, and the max loss is $41 because that is the price that we are going to be paying for this contract. Also, if you move further to the right, you'll see the delta and the theta. These are values that help to indicate the option's value, but to be real with you, I don't really know too much past the fact that theta is the time decay and delta is the percent of change. Another thing you'll want to pay attention to is the IV, which is the implied volatility, which I'll get into later in this video. The higher that IV, kind of the more hype on the contract and the larger the expected move is to be. All right, but now that we've talked about all that, let's get to it. Let's buy our first contract. All right, so yeah, here we are. It looks like the price actually went up. The mid price is 46 now, so I'm going to change that. And yeah, I'm going to hit buy. Does not look like we got filled for that, so I'm going to change it again. Hit modify order. Price is 47, so I'm going down. And yeah, the prices of options change fast. And it looks like we got filled for 46 cents. So if we go to Apple and look at my positions, you can see that I got filled for $46. My total cost is $46. I am now up $2 on this. So I personally want to give it just a little bit, see how this does. And in a moment, we will close this position. And now that we've gotten in Webull and opened the contract together, let's get in Webull and close the contract together. All right, let me fill y'all in with what happened with that last contract. The contract we bought the other day, we actually sold out for profits, but I forgot to record the video. So what's going on right here is we have 2 minutes till market open. I did buy another contract yesterday just because I thought Apple would continue moving up. Apple is actually up $1.17. The contract that I bought yesterday actually expires tomorrow, so there's not much time on it. It's out of the money. So yesterday when I bought it was pretty much very close to being worthless. But if we take a look at it, you can see I paid $12 for it. That's 12 cents per share. The call is an Apple 132 call. I believe I should be up just because I feel like the IV on this may be increasing. All right, so market actually just opened just now because that was my alarm. And as you can see, we are now up $3 on it and now up $1.50. So, let me just take this time and show you how to close it real quick. All right, so if we have a position in Apple and then we go to Apple, I can click on positions, I can click on the contract, and then I can hit sell, and then it'll let me sell these. Or I could also hit close and it'll do the same thing. So yeah, what I'm gonna do, I'm just gonna sell out of this just so y'all can see that. So I'm going to hit sell, confirm, and if the money hasn't had the time to clear on Webull, it's gonna say it's a good faith violation if the money doesn't clear in your account. So just make sure you're trading with money that has cleared. I know this money is good, so I have nothing to worry about. So I'm going to hit OK. And it looks like my order actually filled for more than I tried to sell it for. Now that we've gone into our account and made our first trade, there are a couple things that I want to explain to you. And that's going to be the difference between buying to open and selling to open. Now, you may have noticed that when I was buying a contract that I was also given the option to sell a contract. That's actually referred to as selling to open, and that actually works a little bit differently. Usually when you sell to open, your profit is collected on the front end, and your profit is usually much more limited. It usually requires you to own a lot of capital, or it requires you to own 100 shares of the stock. And with selling to open, the amount that you can lose is usually far greater than the amount that you can make. And here's the answer to a question that I get a lot when people first start selling to open contracts. Whenever you sell to open a contract and you want to close out the contract or take profits on the contract, all you have to do to close the contract is just buy it back. If you're taking profits, you'll buy it back for a lower price. If you're just down on the position and you just want to get out, you'll be buying it back for a higher price. And when you're closing out of that option that you sold to open, it's actually referred to as buying to close. Whereas with the contracts that we purchased earlier in this video, we bought to open and we sold to close. When you buy to open, it doesn't require any extra money other than what you pay for your contract. The most that you can lose is the price you paid, and like I said earlier, it usually has a much greater potential upside. Whenever you buy to open a contract and you want to close out of it, you have to sell the contract in order to close out of it. This is called buying to close. Although options move quite fast, it's actually very important to slow down a bit so that you realize what you're doing. Because if you do something that you didn't intend to, it can really mess you up. That's why I wanted to take a little time to explain the difference between buying to open and selling to open. Now I want to take the time to answer a question I get asked frequently by people when they're trading options. And that question is, do you have to exercise the contract in order to make a profit? And to keep the answer to that question short and simple, the answer is no. If you don't intend on exercising your contract and you're up on the position and you want to take profits, all you have to do is sell to close your position, and just like that, you took profits. Another thing that people really don't seem to understand when they first start trading options is just exactly how instrumental time is to the value of a contract. There are three main things that are going to determine the value of a contract. The first is going to be the intrinsic value, which is dependent on where the stock price is in relation to the strike price. The second thing is going to be the IV, or implied volatility. And the IV is just how much a stock could potentially move. And third, but certainly not least, we have the value of time. With an options contract, it's important to realize exactly how much time you have left on your contract, because the value of a contract decreases fairly little day to day when you have over a month on the contract. But when you have less than a week on the contract, from day to day, the contract will dramatically lose the value that time offers. So the amount of time on your contract is definitely going to be something to look out for. One thing that I failed to talk about really throughout this video are the terms in the money and out of the money. Now, when you buy to open a contract, you want it to expire in the money. That way the contract actually has value on expiration. In the money option will be an option where the stock price is past the strike price in a favorable direction for that option contract. This means that for a call, in the money is going to be any strike price that is below the stock price, and that for a put, in the money is going to be any strike price that is above the stock price. And along with in the money, there's also out of the money and at the money, which is pretty much exactly how it sounds. And at the money option is going to be the exact same stock price and strike price. They're equal, no difference. And out of the money is going to be the exact opposite as in the money, where it's going to be call strikes above the strike price and put strikes below the strike price. And now that you know what it means to be in the money, out of the money, at the money, I'm going to share my opinion on holding options into expiration. Now, this is purely just my opinion here, but unless you plan on exercising the contract, don't hold it till expiration. Because if it expires out of the money, you'll have lost all your money on that contract. And even if it does expire in the money, you likely could have made more money on that contract by selling that contract early and rolling it out to a further date. So my opinion on holding into expiration, don't. It's a pure gamble. Speaking of gambling, there are certain times and certain events that may lead to people gambling on an options contract. These are usually referred to as high IV events, such as earnings, company earnings, or just price action. IV stands for implied volatility, as I mentioned earlier, and as the IV of a contract goes up, so will the price of a contract. Oftentimes when the IV is increasing, the value of the stock will increase whether or not the stock is moving up or down in value. This is all due to anticipation of a large move. One common saying in the stock market is buy the rumor and sell the news. And basically this implies that stocks do most of their movement in anticipation of the news, and that once the stock gets the news, unless the news is just absolutely shatters results, the stock will usually take a nice dip in price because of how much the price ran up going into the news. So if you happen to ever notice the IV or value of your contract going up, even though the value of the stock isn't really moving, just be aware that once the market gets the news, that all that IV can wear off, and that can cause your contract to lose most, if not all, of its value. So in situations like that, it's never a bad idea to take profits early. So one last thing that I want to talk to you about is what happens if you exercise an option, and what happens to the person on the other side of that contract. So like I said earlier, when you purchase an options contract, you are buying the right to exercise 100 shares of the stock at the strike price. This means that for a call with a $10 strike price, you have the right to buy 100 shares of the stock for a total of $1,000, even if the stock is trading at $50 by the time the contract expires. And that for a put with a strike of $50, you have the right to sell 100 shares for $50 for a grand total of $5,000, even if the value of that stock has gone down to $1. As the contract buyer, you are not required to exercise any of those contracts if you don't want to. Again, that means that if you don't want to buy 100 shares or sell 100 shares, you don't have to. But on the other side, the person who sold you that contract, or the person who sold to open you that contract, if you decide you want to exercise your contract, that means that the person on the other side is assigned. And when they get assigned, they don't get to choose whether or not they'll buy or sell the shares from you. They have the obligation to honor that contract. Whether it's selling you 100 shares at the strike price for a call or buying 100 shares from you with a put. As an option seller, they have the obligation to go through with that contract if you exercise it. Now, another question that I get all the time is what options to trade. And while I can't tell you exactly what options to trade, I can tell you what to look for. Contracts that have a high volume and open interest are going to be good to trade because they're going to be a lot easier to get into and out of. And while I don't have any specific values to give you for good volume and open interest, I can show you where to locate it so you can decide for yourself whether or not it's good enough for you. So let's hop in Webull for a quick look.
All right, we're back in Webull one last time in this video, and let's take a look at Alibaba again. All right. By this point, you already know the drill. We're going to hit options, and this time we're going to go in as if we're going to buy a contract. I'm just going to click on this contract with the 240 strike right here. I'm going to do buy instead of sell, since we've talked more about buying to open than selling to open in this video. And from there, before I buy it, I'm going to hit edit. And right here, after we hit edit, we moved on to the screen where we can now buy it. But before we actually buy it, we'll want to take a look at some other things. So before we buy it, we're going to click details. And right here in the details, you're going to have most of the things that you're going to want to know before you get into the contract if you're uncertain. If I'm being 100% real with y'all, just after time, I don't really look at these that much myself, but it was definitely very helpful when I first started. So two good indicators on this page are going to be the volume, which is right above the break even, and the other one is going to be the open interest. Looking at these values right here, just know there would not be a hard time getting in or out of these positions. I personally like those numbers being nice and high. That way I know there's always liquidity. It's always easy to get in and out. Right there in the middle of that middle column is the volume. You're going to want to know where that is. And then just to the right of that is your open interest. And we also talked about this earlier in the video as well. Just to the left of the break even, we have the implied volatility. 42% is rather high, meaning that honestly anything could happen with this contract. But really when it comes to implied volatility, I don't really look at that number too much myself. So yeah, take these numbers, become comfortable with them, and do with them as you will.
Now that I've showed you that, I think you're pretty set to start out trading options. As for what companies to trade, I suggest that you trade companies that you're more familiar with. That way you know the way that they trade. The companies that you trade and the companies that I trade are going to be different, and that's okay. But I have absolutely no doubt in my mind that you can do this. Again, don't miss out on your opportunity to sign up for Webull and get 4 free stocks when you sign up using the referral link down below in the description. If you enjoyed the video, found it helpful, or learned anything, please be sure to smash the like button so that this video can reach those who it needs to reach. And if for some reason you made it this far and you haven't already, please be sure to subscribe and hit the bell notification icon so that you don't miss any future content or giveaways. And if you're interested in getting dope merch like this and supporting the channel while doing it, check out the Teespring link directly below this video and go get yours. And also, if you're interested in joining my Discord, there's a link down below in the description. And last but certainly not least, thank you so much for watching, and peace.